May 1st, 2026. A new month has just started, but the precious metals market has already taken a sharp hit. Gold moved down, silver dropped too, and right after the Federal Reserve made its announcement, investors everywhere started asking the same question. What just happened? And is this just a temporary dip or something bigger? Because moves like this don't happen randomly. There is always a reason behind them, and it's important to understand that reason. In today's breakdown, we're going to clearly understand what the Fed actually did, why gold and silver reacted so sharply, and most importantly, what could happen next. And I'll tell you right now, the real story is probably not what you're seeing in headlines. So stay with me, because the full picture is very different from what it looks like on the surface. Now let's set the context. We have just entered May 2026 after what many analysts called a super central bank week. Several major central banks made decisions, but all eyes were on the Federal Reserve. The Fed decided to keep interest rates unchanged, holding them between 3.5% and 3.75%. At first, that sounds like a normal and neutral decision, but the market didn't just look at the headline, it looked deeper. The key detail was the vote, 8-4. That means 4 members disagreed with the decision. This is important. When there is that much disagreement inside the Fed, it tells us that policymakers are not fully aligned on where the economy is going, and the market reacted to that immediately. Gold, which was around $4,600, pulled back, and silver, which was near $71.90, also moved lower. Now, one thing needs to be clear. Calling this a crash is not completely accurate. This was a sharp correction, not a full collapse. But if you were watching the charts live, it definitely felt strong. And that's why the big question now is, why did this drop happen? Because if you understand the reason, you can better understand what might come next. To understand this drop, you need to know one simple idea. Gold and silver don't fear uncertainty. They often do well in it. But what they do react to is something called a hawkish surprise. That's when the Federal Reserve gives signals that suggest interest rates may stay high longer than expected. And that's exactly what happened here. Even though the Fed didn't change rates, their tone was clear. They are not in a hurry to cut rates. In simple terms, they are saying rates will stay higher for longer. Now think about this. Gold and silver don't pay any interest. You don't earn anything just by holding them. But at the same time, other investments like bonds can give you 4% or even 5% returns. So investors start thinking, why should I hold gold right now if I can earn a fixed return somewhere else? Because of this thinking, some investors begin to sell gold and silver and move their money into interest-paying assets. And when selling increases, prices naturally go down. That's what we just saw in the market. But here's the most important part. This kind of short-term pressure does not mean the long-term trend is over. Markets don't move in straight lines. Even in strong bull markets, there are pullbacks and corrections. These are normal and actually healthy for the market. Another important thing to understand is that markets often move ahead of news, not after it. That means by the time most investors react to a Fed decision, a large part of the move is already priced in. This is why sometimes the reaction feels sudden or even confusing. But in reality, the market is simply adjusting to expectations that were already building in the background. In situations like this, liquidity also plays a big role. When interest rates stay high, money tends to move towards safer, interest-bearing assets. That reduces liquidity in risk assets like commodities, including gold and silver. Lower liquidity can exaggerate short-term moves, making dips look stronger than they actually are in terms of long-term trend strength. It's also important to remember that sentiment changes faster than fundamentals. One week, the market can be extremely bullish, and the next week, it can turn cautious just based on central bank tone or economic data. But underlying fundamentals, like debt levels, supply-demand imbalance, and industrial usage, do not change that quickly, which is why long-term trends remain more stable than short-term sentiment. From a positioning perspective, many institutional investors don't try to time every move. Instead, they gradually build or adjust positions based on broader cycles. This is because they understand that missing the biggest moves by trying to avoid small pullbacks often leads to worse results than simply staying aligned with the long-term trend. Finally, it's worth keeping perspective. One Fed meeting, one correction, or one volatile session does not define the entire cycle. Markets move in phases, and each phase serves a purpose in building the next move. The key is to stay focused on structure, not noise, and let the bigger trend reveal itself over time. If we look a bit deeper, that 8-4 split in the Fed decision tells us something important. It shows there is uncertainty and disagreement inside the Fed itself, and when policymakers are not fully sure about the direction, it often creates a supportive environment for gold in the long run. If we zoom out a bit more, the bigger picture becomes clearer. It's not just about the Fed, it's about what's happening globally. Over the past few years, central banks around the world have been buying gold at a strong pace. Countries are slowly diversifying their reserves, and this trend is still continuing. This is not a short-term move. It's a long-term shift happening quietly in the background. At the same time, if you look at price movements, both gold and silver have already had a massive run. Gold has moved from around $2,000 to above $4,500, and silver has gone from about $25 to near $70. These kinds of moves don't happen by accident. They reflect strong underlying demand and long-term momentum. That's why a short-term correction doesn't change the overall story. Now, in the short term, the big question is what happens next. There are a few key things investors are watching closely. The first is the US dollar. Usually, when the dollar becomes stronger, gold and silver face pressure. And when the dollar weakens, metals tend to rise. Right now, because of the Fed's hawkish tone, the dollar is getting some short-term strength. The second important factor is the 10-year Treasury yield. This is a very important number for metals investors. When yields stay high, gold and silver struggle because other investments look more attractive. But if yields start to fall, that's usually a positive sign for metals and prices can start moving up again. The third thing to watch is what the Fed says next. In the coming weeks, different Fed officials will speak publicly. Every statement will be closely analyzed. Even a small shift toward a softer, more dovish tone could quickly change market sentiment and push gold and silver higher again. Now, let's look at the bigger, long-term picture, because this is where things really matter. The main drivers behind gold and silver have not changed at all. One of the biggest factors is rising global debt. Governments, especially the United States, are carrying massive debt levels, and that debt continues to grow. Historically, when debt gets this high, inflation often becomes part of the solution, because it reduces the real value of that debt over time. And gold performs very well in inflationary environments. Another major trend is what many call de-dollarization. This means that some countries are slowly reducing their dependence on the US dollar for trade and reserves. Instead, they are using other currencies or increasing their gold holdings. This shift is happening gradually, but it is real. And over time, this kind of change tends to support higher gold prices. Silver also has a unique advantage that many people overlook. It's not just a monetary metal. It's also heavily used in industry. Technologies like solar panels, electric vehicles, and electronics all require silver. As these industries grow, the demand for silver keeps increasing. At the same time, supply is not growing fast enough, which creates a gap between supply and demand. When demand keeps rising, but supply stays limited, prices usually move higher over time. That's why many analysts remain bullish on silver in the long run. Some forecasts are very aggressive, but the key idea is simple. The fundamental drivers are still strong. Nothing in this recent Fed decision has changed that. So when you step back and look at the full picture, this recent drop starts to look less like a warning sign and more like a normal pause within a much larger trend. Now the real question is what investors should actually do with all of this information. First, if you already hold gold or silver, the most important thing is not to panic. Short-term drops like this are very common even in strong upward trends. Markets often move up in waves. They rise, they correct, and then they continue again. A single day or the week of weakness does not change the bigger direction. If your decision to invest was based on long-term reasons like debt levels, inflation, or global demand, then nothing about that thesis has changed. The fundamentals are still in place. That means reacting emotionally to short-term price movements can often do more harm than good. Many investors make the mistake of selling during dips and then missing the next big move. If you're someone who has been waiting to enter the market, this kind of pullback can feel uncomfortable, but it can also be an opportunity. Markets rarely move straight up without corrections. These pullbacks often give long-term investors better entry points. One common approach used by serious investors is dollar cost averaging, where they invest small amounts over time instead of trying to time the perfect moment. What you should try to avoid is making decisions based on emotion or short-term fear. A red chart on a single day does not define the entire trend. Similarly, social media panic or hype should not be the reason for buying or selling. The most successful investors usually stay calm during volatility and focus on the bigger picture instead of reacting instantly. In simple terms, today's move is more about short-term positioning than a change in long-term direction. The real story of gold and silver is still being shaped by global debt, inflation pressures, and structural demand, not by one Fed meeting. Let's quickly bring everything together so the full picture is clear. On May 1st, 2026, the Federal Reserve held interest rates steady between 3.5% and 3.75%. But the real market reaction came from something deeper, the internal split in the vote. With an 8-4 decision, it showed that even inside the Fed, there's no strong agreement about the future direction of the economy. That disagreement created uncertainty in the market, and precious metals reacted immediately. Gold pulled back from around $4,600, and silver moved down from nearly $71.90. While this looked strong on the chart, it's important to understand that this was a correction, not a breakdown. Price moves like this often happen after big rallies and are part of normal market behavior. In the short term, The direction of gold and silver will depend on a few key factors. The US dollar, Treasury yields, and future Fed comments will all play a major role. If the dollar stays strong and yields remain high, metals could stay under pressure for a while. But if conditions start to reverse, sentiment can change quickly again. At the same time, the bigger structural forces are still in place. Global debt continues to rise, central banks are still increasing gold reserves, and silver demand from industries like solar energy and technology is growing every year. These are long-term drivers that do not change because of one Fed decision or one market move. So when you step back and look at everything together, the message is simple. Short-term volatility is normal, but the long-term story for gold and silver is still active. The market is not breaking, it is breathing. So the key takeaway is this. You should not judge the entire market based on one reaction or one trading session. What we saw after the Fed decision is a normal market adjustment after a strong move. Prices rise, then they cool down, and then they build direction again based on bigger economic forces, not just headlines or short-term emotions. If you're finding this breakdown helpful, make sure to like this video and subscribe to Metal Market Insight for more clear and data-based market updates. For gold and silver, those bigger forces are still active. Global debt is rising, inflation pressure is not fully gone, central banks are still increasing gold reserves, and silver demand from industries like solar energy and technology continues to grow. These are long-term trends that do not change because of one Fed meeting or one day of price movement. And don't forget to turn on the notification bell so you don't miss future analysis when major moves happen. That's why serious investors usually don't react emotionally to short-term dips. Instead, they look at the broader structure of the market. If the long-term trend is still supported by fundamentals, then pullbacks are often seen as part of the cycle rather than a reversal. Patience and discipline matter more than reacting to every candle on the chart. If you're new here, consider subscribing so you can stay ahead of these market shifts instead of reacting late. Right now, the market is in a phase where short-term uncertainty is high, but the long-term direction is still influenced by strong structural demand. This kind of environment often creates volatility, but volatility is not the same as weakness. It simply means the market is searching for its next direction. If you want more breakdowns like this, stay connected with the channel because we cover these moves in real time. Disclaimer: this content is for educational and informational purposes only. It does not constitute financial, investment, or trading advice. Markets involve risk, including possible loss of capital. Always do your own research and consult a licensed financial advisor before making any investment decisions.